Hello everyone. So in this video, I want to talk about what is a margin call. More specifically with Questrade, when exactly does Questrade execute a margin call? In my first video on what is a margin account, I talk about the margin call. And basically a margin call is when the broker will request for you to fund the account to cover the losses, the paper losses, or else they will be forced to liquidate your positions, your holdings, or your stocks in order to recover the losses. Because basically when you trade on margin, you're borrowing the broker's money to buy stocks. But if they feel that there's a chance that they could lose or that you could lose their money, they'll place a margin call. So they'll give you a chance to fund the account, and if you don't meet the deadline, they could sell part of your positions in order to guarantee their money, or at least to cover the portion that is lost from the borrowed money. Sometimes they won't even give you a chance to fund the account, depending on the amount, of course. Sometimes they'll just liquidate the stocks right away without letting you know, without giving you a warning. So I have to say I'm very disappointed in Questrade's customer service. Not their ability to be accessible or to respond, but in the accuracy of their information. I contacted customer service 7 times, 4 times via chat and 3 times by phone, and every time I had a different answer to the same question, which is what will be my buying power and when exactly do they place a margin call. So I had to look it up online, do my own research, did not find many videos on YouTube explaining this. So here's what I understood from all the bits of information I was able to collect, and I'm sure I'll get more information once I start using the margin account and experiencing it. I'll be able to update you guys with more information. So the first thing I understood is maintenance excess, which is ME, which you can find, which is here right in yellow. ME has to be positive, or else the broker will place a margin call. And the formula for ME, which is maintenance excess, it is negative cash borrowed plus 70% of your current value of your current holdings. And of course, the best way to understand this formula is with several examples. So if I fund my margin account with $1,000 cash, so $1,000 is mine, depending on the stock I buy. So depending on the stock I buy, my borrowing power will be different. So there's different levels of stocks. The higher quality the stock, the more borrowing power you have. So the highest margin requirement you'll get on a stock is 30%. So margin requirement is basically how much, if you buy a stock on margin, how much of that full position needs to be your own cash. So 30% margin requirement means if you buy a stock for 1,000, you only need to put $300 cash. You can borrow $700. So that's what a 30% margin required stock means. For example, Facebook is a 30% margin required stock. But the margin requirement can differ from broker to broker. It's usually very similar, but sometimes a broker can change. So I fund my margin account with $1,000, and I want to buy a 30% margin required stock. Immediately, my total buying power will be $3,333 if I buy a 30% margin required stock. So the amount that I can borrow is $2,333. Let's say I only borrow $1,000 to buy a stock. So $1,000 here. So I'm only going to spend $2,000. $1,000 is mine. The rest is borrowed. $1,000 is borrowed. So my maintenance excess in this case will be $400. So it's a positive ME. It's a positive maintenance excess. So that means I'm good. I won't be placed in a margin call. My broker won't request money from me because according to this formula, the cash borrowed is 1,000. So minus 1,000. Plus 70% of the total value. So as soon as I buy the stock, if I put $2,000 in, the value is 2,000. So plus 70% of the total value. So 70% of 2,000 is 1,400. So minus 1,000 plus 1,400 gives me a maintenance excess of 400. So I'm in the positive. Now let's say the total value of the stock drops 25%. So instead of having a value of 2,000, it drops to 1,500. So the formula for ME, for maintenance excess, I still will have borrowed $1,000. So I'm gonna have minus 1,000 here. It's still a 70% margin required stock, but instead of having $2,000 in value, I'm gonna have 1,500. So my new maintenance excess is $50. So I'm getting close to zero. So basically, if I buy a stock and I'm confident in this scenario, I'm confident that it's not going to drop below 25%, then I don't have to cover any losses. Let's say it drops to 1,000. So I bought a stock with $2,000. So the total initial value was 2,000, but the stock drops 50%. So total value is 1,000. So if I replace 1,500 by 1,000 in this situation, I'm going to have a negative maintenance excess, minus $300. So in that case, I'm going to be put in a margin call position. They're either going to ask me to fund the account to cover the loss, or they will sell positions in order to recover their loss or to protect themselves from losing money. Because basically they're protecting themselves from losing money because their 1,000 borrowed is still available in the stock. But of course, they don't want to be put in a position where the total value of the stock is less than what I borrowed from them. So that's their formula for maintenance excess and to protect themselves from losing money. Now let's say out of the 2,332 that I can borrow, instead of borrowing 1,000, let's say I only borrowed $500. So total value of my purchase is $1,500. $1,000 is mine, 500 is borrowed. So to begin with, my maintenance excess is 550. So minus the amount that I borrowed, so minus 500, plus 70% of the total value, plus 70% of 1,500 gives me 550. Now let's say this 1,500 drops to 1,000. The amount that I borrowed is still minus 500. So my maintenance excess is 200. It's positive, so I'm still good. I'm still fine. I don't have to pay anything. I won't be placed in a margin call. If the value of my stock drops to 750, so initially it was 1,500, drops to 750, I'm still good. I've got a positive maintenance excess, so no margin call, but I'm definitely getting close. So by borrowing less, I actually have more room to play around with, or more room for the stock to drop before the broker places a margin call. So obviously the 70% in this formula, it's not a fixed number. It comes from the difference. It's basically 1 minus the margin requirement. So 100% minus 30% is 70%. So when you're trading with a stock that has a 30% margin requirement, the formula for ME will be minus cash borrowed plus 70% times current value. So if we want a more general formula, it's going to be plus, instead of the 70%, it's going to be 1 minus the margin requirement. Margin requirement here being 30%, that's why we have 70% here. So in our other example, when the stock dropped half, when the stock went from 2,000 to 1,000, we were placed in a margin call. In this example, we're dropping half and we're not placed in a margin call because we didn't borrow as much. In the other example, we borrowed 1 for 1. Here, we put in 1,000, but we borrowed 500. So from all this, I wanted to know, well, how much room do I have before the broker places a margin call on my account? That's what I want to know when I buy a stock, because of course I'm not going to buy it at the lowest point possible. If I buy something, let's say I buy Facebook at 150, I don't think it's going to go up immediately after I buy it. So it might drop a bit. So how soon will the broker place a margin call on my account if the stock that I bought drops? So that's what I wanted to figure out. And here's the formula that I came up with to help me figure out the percentage that I have, or the room that I have for the stock to drop before they place a margin call on my account. So in this example here, if the cash that I put in is 1,000 and I borrowed 500, based on this formula here, the stock can drop 52% before a margin call is placed. So it gives me a lot of room. And here's the proof. The stock dropped 50% and I still have a positive ME. Now, to confirm this, basically if we take 48% of 1,500, our ME should be 0 or close to it. So instead of having 750, which is half of 1,500, let's put 48% of 1,500, and we're down to 4. So based on how much I borrowed compared to how much I put in, I can calculate how much room I have for a stock to drop before the broker places a margin call on my account. So let's go back to the first example with $1,000. So I put $1,000. I borrow $1,000. I basically have the stock can drop 29% before the broker will place a margin call. So to test that, we're going to put here 71% of 2,000. And here I borrowed $1,000, and here is still 70%. So yeah, I'm at -6. So with this formula here, I'm able to know the room I have before the broker places a margin call on my account. Now let's say I borrowed $1,500. So if I borrow $1,500 and I only put in 1,000, I only have 14% to play with. So in that case, it would be a little bit risky because I've bought stocks before that have dropped more than 14% after buying them. And in that case, well, it's not too risky because even if it does drop, I just have to cover the losses. So if I don't have the money to cover the losses, then it becomes risky because they're going to sell my positions. Even if they're at a loss, they're going to sell my positions to recover the borrowed amount. So if I know I don't have available cash to cover any future losses, then I should not be borrowing this much compared to what I put in. So if I'm buying a 30% margin required stock and I put in 1,000, I could probably trade with 1,000. I could probably borrow 1,000, giving me 20% room, which is okay. If I take half, I've got 52%, which is even better. I got 40%, which is pretty safe. Rarely do I buy a stock and it drops 40% more. I mean, the only time that happened was GE and maybe, yeah, pretty much GE. Kraft Heinz, I think it dropped like maybe 20%. So yeah, it rarely happens. So in my case, maybe between 750 and 1,000 would be the max that I'd borrow if I fund the account with $1,000. And that's if I know that I can't cover the losses. Let's say I borrow $2,000. So I put in 1,000, I borrow 2,000, so my total value is 3,000. So as you can see, to begin with, my maintenance excess is much lower. It's at 100. It's positive, but it's much lower. So I don't have that much room to play with. And as you can see here with this formula here, I've got only 5% to play with. So that's definitely risky because for sure a stock that I buy can drop more than 5% after I buy it. So that means very soon I'm going to have to start funding the account to cover the losses. Because if the total value drops to 2,800, for example, I borrowed 2,000, I'm already at a negative maintenance excess. So the max the stock can drop is 95% of the initial value. So basically 2,850. If I put in $3,000 total value, as soon as it drops below 2,850, I have to start covering the losses. So it's not enough room to play with. So that's why I think from 750 to 1,000 is fair in my case, in this scenario, because I'd only have to start funding the account. I would only be placed in a margin call at around 30% or 29% down from the purchase price. So let's say I fund the account $2,000 instead of $1,000. Does it change anything? Well, I've got more money to borrow. I'm gonna have $4,666 to borrow if I'm buying a 30% margin required stock. Let's say I borrow $2,000 as well. So I'm down to 29%. So it's the same thing as you can see. So it's when it was 1-for-1, it was 29%. If I borrow half, I'll be at 52%. There you go, 52%. That the stock can drop 52% before I'm placed in a margin call. If I borrow 1,500 on the 2,000 that I deposit, I would have the stock can drop 39% before a margin call is placed on my account. So basically 61% times the initial value. So you see I'm at a negative ME when the stock drops 39%. So what's great about trading on margin is I only put in 2,000, I borrowed 1,500, so total value of the stock is 3,500. But if the stock moves 10%, well, not only am I going to make 10% on $2,000, but I'm going to make 10% on 1,500. I'm going to make 10% on the borrowed money. So the $150 that I make on the 1,500 that I borrowed is mine, and all I have to do is pay interest on the 1,500 that I borrowed. So depending on how long I borrowed the 1500, it's a minimal amount. The interest with Questrade is 8% per year, approximately. It's different from Canadian and US stocks, but for example purposes, we're going to say 8%. So if you borrowed a stock, so if you borrowed 1500 for 3 months, let's say, you'll be paying $30 interest on that money, but you would have made $150 with that money. Now 10% is probably not a big gain, but imagine you make 20%. So that's 20% of 1500, which is $300, and you still only pay $30 in interest if you made 20% in 3 months. If it's 100% gain, well, 100% on 1500 is 1500, and obviously depending on the time frame, let's say it takes a year or 2 years, the 100%, you're still, the gains that you're making, the 100% return that you're making, it'll be on your cash, on your money, plus on the borrowed money. So basically it allows you to increase your returns, but it can also increase your losses. So that's the risk involved with it, of course, but it's a faster way to grow your portfolio. So when my account gets activated, which should be tomorrow, I'm going to start using it. I'm going to find out what my exact buying power is, and I'll definitely have more information on how a margin account works. I'll show you, but based on the information I collected and researched online, this is my understanding of the margin account, and it makes sense. And what I really wanted to know is how much room I have before a margin call is placed. I mean, sometimes you'll have a margin call on $20, let's say, and they'll give you 2 weeks to cover that $20. So you don't even have to fund the account. You can wait for the actual position to go back up, which usually is the case, and then you don't even have to fund the account and the margin call goes away. So it really depends on the scenario, on the situation. Obviously, if you're trading with blue chip stocks, that risk is much lower of being in a margin call, of finding yourself constantly funding the account to cover losses. And obviously, if you're buying at a relatively low price. Now, there's another thing with Questrade, another advantage with Questrade is you can link your margin account to your TFSA. So you can use your TFSA to increase your buying power in your margin account. So once again, based on the information I collected from Questrade, this is my understanding of how this works. So let's say the value of my TFSA is $6,000. The portfolio in my TFSA is $6,000. So this is how it would increase my buying power. So if I put in $1,000 in my margin account, my buying power would be $7,331 because it's linked to my TFSA, which has $6,000. Now let's say in this case, I only borrow $1,000. Remember in the first scenario, when I did that, I only had the room I had for the stock to drop was 29%. In this case, the stock can drop 82% before a margin call is placed, because basically current value here will include my TFSA, will not just include the purchase I made, it'll include my TFSA portfolio. So the whole value of my TFSA portfolio plus the purchase I made in my margin account would have to drop by 82% before they place a margin call. Before they place a margin call in the case where I borrow $1,000 and fund $1,000. Now let's say I fund the account $1,000, but I borrow $2,000. I have 68% room, which is very good. So that means I can actually borrow more than I'm using. That means I can actually borrow more than I funded. And it's not that risky because I would need my whole portfolio to drop by 68% before a margin call is placed. And once again, that's if I understood correctly. But I think I did because it makes sense this way. And I'm going to be able to confirm everything once I get the account up and running and start using it. So if I borrow $3,000 and I fund $1,000, I've got a total value of, I would need the stock to drop 57%. So $4,000, if I put in $1,000, I borrow $4,000, I would need the whole portfolio, TFSA plus margin account, to drop 48% before I'm placed in a margin call. Because based on the formula here, the cash borrowed here would be minus 4,000. 70% is the margin, 1 minus the margin requirement, so 70%. And total value, or 70% of and the total value would be the 4,000 that I bought with in my margin account, which comes, and then current value would be the 5,000 that I trading with in my margin account plus the 6,000 that I already have in my TFSA, so 11,000. So minus 4,000 plus 70% of 11,000 gives me a 3,700 ME, which is a pretty high ME. So that's why I've got more room before I'm placing a margin call. So in this case, by linking your TFSA to a margin account with Questrade, it becomes very interesting. But in the case where I don't link it, by borrowing exactly what I funded, in the case of a 30% margin required stock, I only have 29% room to grow. I only have 29% room to play with before a margin call is placed. So it's not so bad. I'm still getting an extra, I'm still investing with double my investment and keeping the profits of the borrowed amount and just paying interest on that borrowed amount. And of course, I'm just using 1,000 as an example, but imagine you're putting $10,000, right? So you've got 23,000 that you can trade with, that you can borrow. So let's say you use $10,000 trade with, it's still the same ratio. So you still got 29% before you have to start funding your account, or before you're placing a margin call, and you have to start covering the losses. But if you make a trade that generates 20% return, 20% profit, you're making 20% on your 10,000 and you're making 20% on the borrowed 10,000. So you'd be making a profit of 4,000, but you only put in 10,000 of your own money. So you actually made 4,000 over 10,000. So you made 40% instead of actually making 20%. So you bought a stock at $10, sold it at $12, that's 20%. But because you're trading with double your investment, which is money that's not yours, which you're going to return after you sell the position, instead of making 20%, you're making 40%. And you're just going to pay interest on the $10,000 that you borrowed. So that's what's great about the margin account. But unfortunately, all this is taxable. So as soon as you sell a position, if it's a capital gain or if it's a business income, so if you're day trading or even swing trading, it's going to be considered as a business income. So 100% of that gain will be added to your income, and then that income is taxed depending on your tax bracket. If it's an investment and you hold long term, like over 3 months, so it's considered a capital gain. So 50% of your profit will be added to your income, and then your income will be taxed depending on the bracket that you're in. So obviously because it's taxable, you're able to deduct the trading fees plus the interest from your profits. And any dividends you receive while holding a stock will be taxed also, but dividends have their own tax rules. So yeah, so that was my explanation of the margin call with Questrade. If you have any questions, leave them in the comments below. And like always, if you're going to open an account with Questrade, use my referral code in the description below the video to get between $25 and $250. Thanks for watching.